Hey, welcome back, traders. It is Thursday, May 23rd, 2024. I'm recording this on Thursday night because I'll be traveling tomorrow for the Memorial Day weekend. So it's time for a general market update. Again, the presentation is by Rain King, and it's for educational purposes. All right, the agenda tonight is going to be going over the indices and breadth as we always do. And then we're going to do an educational segment on positioning, and then we will summarize. So let's go over the indices and what's going on with the breadth of the market. All right, here's the NASDAQ as of the close today on the 23rd. Today we had a kind of a gap open on the NASDAQ with NVIDIA, but underneath the surface, things reversed and were not very strong. So let's go over the chart here. A couple things. About last Friday, we noted on the chart that we did have a stall day with some high volume. Here we are this week, and we had the, like I said, the open, and then we had the reversal. So a lot of intraday reversals probably caught a number of investors kind of off guard, a little enthusiastic about the NVIDIA earnings report. But under the surface, on the headline, leaders stocks really held up kind of okay. But there were some other ones that took on some water. Now, some things that to note that are not the greatest are new highs, as you can see in this lower pane, have flattened out, and the new lows in red are starting to pick up. So that's kind of a caution sign. So this is also a distribution day today. And also at the top of this chart, I've shown the percentage of NASDAQ stocks above the 50-day moving average. And just looking at perspective, this is from late December. We made a new high in the index, and you can see we had almost 90% of the NASDAQ above the 50-day. Then in early February, we made another new high, but we only had 62% above the 50-day. And then we went through this kind of sideways chop with a lot of distribution days, and the line was steady about 62, and then the market broke open, and we kind of waterfall down in the correction. And then when we've come back here, what's interesting is now we're at new highs again, and you can see that the percentage above the 50-day is only 46%, I believe it is today. So that's not a good sign when you continue to see new highs, but the NASDAQ participation is weakening. So that does not line up the way we'd like. Now, interestingly enough, what's interesting about today's reversal, the last big reversal we had was when Jim Roper was on the IBD podcast. And yesterday, Jim Ropel again was on the IBD podcast, again, all bulled up. So we had the downside reversal today, only using some tongue-in-cheek here. It just happenstance that when Jim's on the podcast, look out, watch your stops. Okay, now another way to look at this is to just look at the NASDAQ 100 versus QQQE, which is the equal weight of the NASDAQ 100. You can see we had 7 days of highs on the Qs, which looks really great. But unfortunately, you can see under the surface, the equal weights have not made new highs, meaning they're just not as strong, and that the dominance of some of the names like NVIDIA and some others are really pushing this index. So it's not as strong as it looks like in the index. Now, moving to the S&P, again, as of the close, this is the look on the S&P 500. You can see I'll start with this. We had 2 back-to-back distribution days, and you'll notice there's the reversal we had today. And today was a kind of a rout on the New York Stock Exchange. 85% of the names declined today. Not a very good day. And you'll also notice that new highs have also started to drop off pretty steep, and new lows are starting to pick up a little bit. So again, not what we want to see. Tomorrow will be a very interesting day if the market can refine its footing. But this is just showing a little bit of caution signs on the rally. So we may gather ourselves here, but we'll have to see what tomorrow brings. This is the New York Stock Exchange. This is the advanced decline line. I believe I showed this last week or 2 weeks ago, and it was very strong. We were making new highs in the S&P, and we had a nice new high in the advanced decline line. Well, it looked excellent last week. quite a turn down so far this week. So this is a pretty bad drop, showing that, again, the breadth in the market has taken kind of a hit this week, and it's consistent what we saw on some of the other charts and indicators I just showed you. So I want to move to an educational section. I'm calling this positioning. So let's look at this. We are actually, what, plus or minus 3 weeks into this new rally. We're always trying to find out who are the true market leaders, who are the best stocks in the market. And you'll hear people say, and Bill O'Neill would say, and you should rank your stocks, whether you do that each night or you do that once a week. And the question is, what is your best stock? And, the default that most people come to, well, they think if it's a trick question, they say, well, it's the stock that I have the most gains in. And we're going to get into this because there are situations when that's not the right answer. Just because you have big gains in a stock does not mean that's your strongest stock at the time. So let's explore this a little closer. Now, we always want to be thinking about risk and reward. So when you're reviewing your charts to determine the best stock, you want to look at the chart, you want to look at the company fundamentals right now. And you want to try and be as unbiased as you can to evaluate the stock. And say to yourself, if I'm going to buy that stock today, what is the risk reward? What is the upside potential from where we are today versus what is the downside risk in this stock? And really try to answer that honestly, and it can help you with answering the question, what is your best stock? Does the stock you own currently still have catalysts to drive it higher? And do you have conviction in knowing the story and you really believe you have one of the true market leaders? So you can't be hoping your stock's going to go up, and you want to try and be unbiased. It's hard sometimes when you own a position to really, really stay neutral. So let's just review what I call the life cycle of a growth stock. So, when we're at a market bottom, that's when stocks form their first base. And this cycle that I'm going to show you is pretty typical for growth stocks in a bull market. Generally, as we come out of the follow-through day with the initial rally, that's when companies start to have positive earnings surprises. Usually a quarter goes by, then they have situations where analysts need to revise the estimates up. The businesses for growth stocks are looking good. And a stock that keeps moving higher has, earnings per share momentum. And it's important, true market leaders, and if you're going to try to hold a model book stock as a position trader, you're going to have to survive 3 to 4 earnings reports to capture the big move. That's become increasingly difficult with some of the volatility around earnings reports. It's just the way it is. It's I don't like it. Other people don't like it, but it's can be a crapshoot. But if you're really trying to hold, you got to have cushion, and you got to be very, very conscious of the risks. So eventually, when a growth stock after a year or two tops out, that's when we start to see the chart give sell signals. And on the earnings side, you'll start to see the loss of earning momentum. The company executives will start to guide lower. Analysts will start to lower their projections. And then usually shortly after that, the next quarter, you're going to see possibly negative earnings surprises. And the stock by that time is really probably all cooked. So we want to be aware of this kind of general life cycle of a stock. And Nicholas Darvis really said it best. The biggest factor in stock prices is the lure of future earnings. The dream of the future is what excites people, not the reality. Stocks are always, and analysts and the markets are always looking ahead. And it's that lure that the stock will deliver big numbers at the next quarter or 2 quarters down the road. So we want to be aware of this cycle and where your stock may be in this cycle. Now, I want to show this. This is actually a page out of the model book stock book research that I did for the 2016 to 2018 bull market cycle, where you studied all the model book stocks. And this just shows the leaders that are in that study plotted against the NASDAQ. Okay. Now, what I want to do is overlay in a bull market. In this case, the rally started in February of 2016. There's always a leg up, then there's a consolidation or a correction. There's another leg up, and there's a consolidation or correction, another leg up. And this third one we had in this particular bull market, and we had a correction. And then we had the final leg, and the market peaked and found its top, and that was in late 2018. Now, the point I want to make is you notice that the biggest winning stocks broke out at various points along the bull market. You had the ones breaking out with the initial leg, and that's usually your big leaders. But out of every correction, you'll see there are other leaders breaking out. So there's rotation into new growth names. You can see there's leaders here. Coming out of this correction, there were other names that broke out. And then eventually we get to the top. So this cycle is important because we're going to relate that to today's market. So it's kind of like a horse race, and we're always kind of jockeying for position in bull markets. So if you look at the beginning of the bull market that started in earnest here in November of 2023, that's the beginning of the market. And if in a horse race, that's when the horses are kind of coming straight out of the gate. And we're trying to figure out what horse is the right one. And we never really know for sure which horse coming out of this gate is going to be the winning horse. But we're trying to identify that. And the market moves up through bull leg number one. So by the time bull leg number one in this long bull market, we're kind of reaching our first correction, just like that template I showed you from the 2016 to 2018 rally. So we've had our first kind of pullback or correction, April and May, and we're coming out of it right now. So we're watching very closely. So in this horse race, we're kind of coming down the backstretch, bull leg number one. And here we are, we're kind of starting up what might be bull leg number two. So as we're coming out of bull leg number two, we really want to identify, are the stocks that we're holding, are those the big leaders? Is that going to be the winning horse? Now, if we're on a slow horse that we took early in the market, we're trying to saddle up to a new horse, saying maybe I should change horses and get on to one of the big leaders. So you may need to change horses as we're going down the backstretch. But if you have one of the big leaders that came out of the gate, what you want to do when we move out of the next leg is you want to ride that horse hard, and you want to keep building a bigger position for the model book stock move. And again, there could be multiple corrections and legs in a bull market. Could be 2, 3, 4, 5. But eventually you get to that final bull leg of the market, and that's when the stocks are coming and horses are coming around the far turn, headed for home. And eventually, as we reach the market top, that's when we get to the finish line. And that's where it's so important that we have the sell rules, because we have to sell that big winner right if we're going to capture the big prize. So it is like a horse race. We don't know coming out of the gate who is the right horse to be on, but we do need to jockey and find a way to get in and get onto that right horse. So it's all about kind of jockeying for position. So let's look at a couple of scenarios with these diagrams. This is scenario A. Let's assume here that you in November and December, you bought some stocks, but it turns out they were not the right horse. They were not the big leaders. So somewhere along the way, you sold that stocks. Maybe you made some gains. And then we come up to the April and May correction. So we're really coming out of this correction right now. So what your position is, you're trying to find a way to buy the new horses of this rally. And hopefully over the past few weeks, you have identified and gotten yourself positioned in some of those proper horses that could be winners in this next leg up. So it's a case of wrong horse at the beginning of the move, and you're trying to get into the right horses. Now let's look at a second scenario. The second scenario is you bought some of the big leaders in November and December, and you actually have ridden them up in bull leg number one to, this March, April timeframe, and you're trying to hold for the big move. So hopefully you said, I've got a good cushion, and I'm going to hold through a potential base that might form. So if you've been successful holding through the base, and you're coming out now for the next bull leg up, and this stock is breaking out, and it's a stock that you have a good position in, you've got good cushion, this is where you can be aggressive. You can take a much more aggressive stance when you have a big cushion and you're adding to a big winner that you have from the beginning of the move in the bull market. So it's all about jockeying for position. Every trader is in a different spot. So I wanted to point that out just to set kind of scenarios in your mind. Now let's come back to this idea of ranking your best stocks. And I've made the point that it might not be the one that you have the biggest gains, because we want to think about risk and reward. So let's assume the first stock, call it stock A. Let's take a scenario where it came out of a base and you bought it right here, right out of the base, looking really good. You held through the next base. So under the stage 2 base, you held through that and it came out of that base and you added. So you got a really nice position. The stock moves up again to a nice, maybe a flat base, something at stage 3. It's getting later. And the stock really starts to move strongly and you have great gains. Let's say in this scenario, you're up 150%, but we're very, very extended in this scenario. We're about 100% above the 50-day moving average. And the stock has shown you that the price action has gotten wide and loose. And maybe you're starting to see some subtle sell signals starting to pile up. So that's stock A, big gains. But here's the position that it's in on the chart. Let's look at stock B. Again, stock B, you made good buys in November and December. You have a leading stock. It moves up. We get to this April and May correction, and you held through the base. So you held through the base, and the stock is starting to move. And let's assume it breaks out, and you've got 50% gain in this stock coming out of a stage 2 base that you've got some good lower cost. We'll call that scenario B, stock B. The third stock, stock C, is a stock that you didn't catch the big move. You did not identify the leader back in November and December, but you've been really, really watching your watch list and you have found the stocks that you think are the leaders coming out of this correction. So you've taken new positions. So you have new positions here that are coming out and they're starting to gain traction. So you've got small gains at this point. You've just come out of the base with new positions. You've got a 5% gain here. So the question is, which one of these is your best stock if all 3 of these were in your portfolio? We've got real fresh buys with 5% gain. Maybe you just had a nice earnings report. Stock B, which is a stock that you're adding to. You've already got a 50% cushion. And stock A, which is your biggest gainer, but it's very extended, maybe getting late in the move on the technical chart. I would argue that stock B is your strongest stock. So it's just, this exercise is important. Don't default to say, well, my best stock is the one I'm up on the most. Think about the risk and the reward. Stock B, you've got a situation where you have a 50% gain. And if you add to this properly, you might get another nice move up. And if this doesn't work out, you can cut it short and still preserve your low cost stock. There's a certain amount of risk in this because you don't have any cushion. So you'll have to cut this very quickly if it breaks down and the breakout fails. So you don't have much here to work with. You've got a lot more to work with in stock B, and you've got great gains in stock A, but you have to realize when it might be time to sell and move your money to another stock. So positioning is important, and you want to force feed your best stocks. So as I mentioned before, if you're starting in that third scenario C, where you got some pilot positions, you've just initiated positions and they're working, you want to watch what happens closely on this first pullback post breakout. You know, the stock, if you think it's a leader, it should already be at new highs. Check the volume on the up days versus the volume on the down days. It should be receding on the down days. Look at the ranges of the price range. It should be expanding on up days and contracting on the down days. Look at that relative strength line. It should be angled at 1 o'clock or 2 o'clock, and holding the 20 EMA is also a good gauge if you really are in a leading stock. Usually the 20-day will hold. Now, the second scenario we mentioned is a situation where you've got really good low cost, good gains in a stock that you're holding from the November to February rally, and you're trying to really get more money into this stock. So we still want to pay a lot of close attention to this, because if the stock breaks down, you might need to sell the last ads. But if you do have a 40, 30, 40, 50% cushion and coming out of a nice base, you can be in an aggressive mindset. And your goal is to build a bigger position in what you think really could be a model book stock move. We don't plunge in. We want to strategically make our ads. Now, there's a very lot to consider when you're building up a large position. You got to look at your psychology. You got to think about risk management. Should you be on margin? Should you not be on margin? When do I sell? How do I manage a large position? These are things that in the Rain King Cloudburst series, we're going to have some educational sessions that go deep dives into how to really build large positions and actually manage your risk, so you're not taking big risks, but you maintain a lot of upside. So this is all about positioning. So let's get back to the general market and summarize. So where are we at? Well, the S&P and the NASDAQ, they hit all-time highs, but they had a reversal today off those highs. The question is going to be on Friday, does the follow-through lower occur? We want to watch it closely. There are some caution signs I mentioned in the video about new highs and some of the other things that we mentioned about breadth. So we want to be very observant of what's going on. Now, we did have a power trend turn on. So it's going to be interesting to watch the Friday close relative to the 20-day moving average and pay attention to that for clues. Now, as I mentioned, net new highs and new lows. The net new highs in the NASDAQ has fallen off, and as we were pushing higher, the new lows are getting smaller. So those are yellow flags, as I mentioned, and the percentage of the NASDAQ above the 50-day, it certainly looks questionable. The action of the leading stocks. The leaders today and all the volatility, most of the leaders held their gains. There were a few that got hit hard, like ANET. We want to see how the big leaders can digest their gains. So it's important to see how we close Friday. So we still got another day of trading. Exposure levels, I lowered them slightly to 60 to 75%. And I think I say that because we don't want to dislodge a good position that we have that has cushion. Okay, so that's important. We don't want to panic. But we also, if we've made some pilot buys and they're not working and things reverse and get worse, you're going to want to cut those and maintain your stops to really protect the downside. So it all depends on your positioning in the market right now. I think if you're positioned properly in some of the big leading names, then the exposure I'm showing, I think, is appropriate. Some of you might be more aggressive and some of you may be more conservative. That's just where I feel that I am today. So that's the summary. Now to the quote of the week. Quote of the week is, I think greed is healthy. You can be greedy and still feel good about yourself. Now this is from the legendary trader from the 1980s, Ivan Boesky, who passed away this week. He was a stock arbitrage trader. Really a flamboyant guy in the 80s. His game was corporate mergers and acquisitions. Ultimately, he was convicted of insider trading. He started to work on the inside with different brokers and getting insider information about these big corporate mergers that were pending. And he made, tens of millions of dollars. But he got caught, and eventually he squealed on many other brokers, and he also squealed on people like Michael Milken, who was the junk bond king from the 1980s. So, he's kind of the epitome of some of this. And if you ever saw the movie Wall Street with Michael Douglas, Gordon Gekko, that character was patterned after Ivan Boesky. So certainly a great historical figure on Wall Street. That's the quote of the week. So coming soon, Rain King Insights. I'm still plugging away. We're looking at July 1st as a launch date. If you want to be on the early bird list for a coupon to join the potential site and take advantage of it, just send an email to support@rainkinginsights.com. That's the market update for a special edition on a Thursday evening, May 23rd, 2024. Have a wonderful Memorial Day weekend, and we'll all get back to work next week on the market. So enjoy the holiday weekend.